Hello, everyone. My name is Darren Joseph from IGTA.tax, and we're a team of cross-border tax advisors that seek to demystify the sometimes confusing world of international tax. And today we have the honor and the privilege of having an in-depth conversation with Senor Jose Aguilar-Shea. Jose, would you like to introduce yourself, please?
Of course. Thanks a lot, Darren, for the opportunity, and obviously happy to chat about the Spanish Texas. So I'm a tax partner in international firm Squire Patton Boggs, based in Spain, in Madrid, Spain, and obviously was very used to working with international private clients, moving to Spain and planning ahead. So I hope we can make a useful conversation to anyone looking to move to Spain or having cross-border issues.
Fantastic. Appreciate it. So generally speaking, so we're saying that if someone is coming from, let's say, a common law jurisdiction, that, things like trust may not be as efficient. So unfortunately, sometimes clients come to you with, bad habits. They already have structures in place. So you need to try and work with what they have. But if someone came to you like clean slate, they have nothing at all. What are the tools that you would normally pull out of your toolbox to work with them and that you find to be very helpful, generally speaking?
Yeah, so I mean, the ways that we can have, let's say we don't benefit from the Beckham law and we're able to apply, let's say, I mean, the most concerning what I'm seeing, obviously, it's that income tax. I mean, you kind of end up paying income tax anywhere, and we can accept that. I mean, there's Dubai, there's others, but the most difficult situation to go around is to understand wealth tax, right? Because wealth tax doesn't make sense, right? I made my wealth. Why am I paying you for having my wealth, right? I'm already paying income tax. It's a double tax. And Spain is the only few countries that still has it. I mean, just so you have a brief background, wealth tax is kind of allocated to each region. So until last year, like, for example, regions as Madrid, Andalusia, or Galicia didn't have wealth tax because it was there was a 100% rebate on the tax. So it was tax-free. But again, to avoid that discussion between the regions, that have so much different taxation, the federal government, the central government decided to approve an exceptional wealth tax on a federal level, which only applied in those regions that actually didn't have a practical wealth tax. So again, there's ways that we can work around that. For example, one of the points that I think it's worth is if family-owned businesses, family-owned companies that actually are active within the individual or the family would be excluded from the wealth tax computation, right? The calculation. So that's important. If you have family-owned businesses, your ways to structure that are saying, a U.S. person still owns a business, has a business which is worth 20 million, 50 million, whatever. If it could be planned ahead so that that asset, that business doesn't account for the wealth tax calculation.
Right? You're right.
And just to make a small, a relevant point here is that within this special tax that applies for worldwide assets, now there's also a way that if you have the point on wealth tax is that it's a higher income tax burden. But the point that they raised is if you have, let's put it the situation, you have lower income because you're retired, you just have a small pension, but you have this big wealth, you're able to minimize your wealth tax exposure down to 80% reduction. So this means, let me put the example, what are the Spanish authorities trying to avoid? Let's say my only asset is a building which is worth 10 million. And you can get to a situation, but I have no income. So let's say I have to pay 200,000 in wealth tax, but I don't have any income to pay that. So it doesn't make sense that you penalize as well. So what they said is, well, there's no zero tax, but I'm able, if you're low income, you're able to reduce your wealth tax exposure down to 20%, which is very interesting. So, and again, now you say, well, but I have more assets, I have financial assets, I'm receiving capital income. Okay, so that's what we have. How can we benefit from this rule that we allow to have investments, not direct investments, but you apply funds. And it's very common in Europe that we have a special funds transfer regimes where there's no taxation, right? So we investment regimes. So if you, instead of buying bonds and receiving monthly coupons or quarterly coupons, if you can have a fund that invests in fixed income, capital, whatever you want, but you're only taxed when you pull the money out. So that means that your actual income is zero. You have your contributed in different funds. So that's the way you can plan. Instead of having your individual investments, you can do a planning through investment funds. You have UCITS, you have other ways of benefiting from that from a regulated perspective, SECOBs and other vehicles, but that's a way so you can minimize the wealth tax exposure.
So if you're a 6, 7, or 8-figure investor, entrepreneur, or business owner who needs a tailor-made solution from a qualified team of professionals, we can help you achieve the international lifestyle the freedom, and even the tax savings you're looking for. Visit us at htj.tax and live that international life.